Imagine you have a big piggy bank filled with all the money in the world. Now, picture your parents suddenly introducing rules that decide how much of that money goes into or out of the piggy bank each day. These rules are called interest rates, and they play an incredibly important role in the whole economy. Interest rates aren't just about saving money. They affect everything from how businesses grow to whether you can afford a house. So, here's the million-dollar question. How do these simple numbers move the entire economy? And here's the surprising part. Interest rates don't just exist in banks. They're like invisible handbrakes on the economic car, slowing down or speeding up its movement. All right, so let's dive into how those interest rates move the whole economy. You might hear people talking about them, but do you really know what they are and why they matter? Well, imagine each of us has a piggy bank, and we use this money to buy things or save for the future. Now, here's where it gets interesting. There's a group of grown-ups called central banks. The Federal Reserve is one example in the U.S. These folks make decisions about how much piggy bank money everyone can get at any given time. They do this through something we call interest rates. Think of these interest rates as the rules for borrowing and saving piggy bank money. When the Fed raises interest rates, it's like they're saying, okay, you can have more piggy banks, but it's going to cost you extra. This makes people think twice before taking out a big loan or even buying a house. Conversely, if the Fed lowers interest rates, it's like saying, go wild. You can borrow as much as you want, and it won't cost you too much. This encourages borrowing and spending, which can boost things like business investments and consumer purchases. And here's the surprising part. Changing these rules doesn't just affect banks or big companies. It affects everyone. When interest rates go up, it makes saving more attractive because your piggy bank earns more money. But it also makes borrowing harder, so people tend to spend less on cars, homes, and other big purchases. When rates are low, the opposite happens. People might feel braver about spending and investing, which can lead to economic growth. But this can sometimes be a double-edged sword because too much spending without enough savings can lead to bubbles, like the tech bubble in the early 2000s or the real estate bubble before the financial crisis. So, that's how interest rates work behind the scenes. They control the flow of piggy bank money across the whole economy. By making borrowing more expensive or cheaper, central banks can influence spending, saving, and ultimately, the health of the entire market. So, how do interest rates affect borrowing? Let's dive into the piggy bank analogy to understand it clearly. Imagine you have a magical piggy bank that can either make your money grow or shrink depending on what happens in the economy. This magic is controlled by something called interest rates. When interest rates go up, it's like asking for extra coins if you want to borrow from this piggy bank. The more you borrow, the more extra coins you need to pay back. For example, let's say your friend wants to buy a new bike and borrows $100 from your piggy bank. If the interest rate is 5%, they only have to give you back the original $100 plus an extra $5 as interest. But if the interest rate goes up to 10%, that same loan would cost them $15 in interest, making it more expensive. Now, here's the surprising part. When people see higher rates, many decide to borrow less or not at all because the costs are just too high. They might wait until rates go down again, saving their money for other things. This means fewer big purchases like cars and homes, which can slow down the entire economy. On the flip side, when interest rates go down, borrowing becomes cheaper. It's like getting a discount on your piggy bank loan. Suddenly, it might be easier to buy that new bike or even a bigger purchase like a house. More people feel confident taking out loans and making big purchases, which can actually stimulate the economy by increasing demand. So, you see, interest rates act as a powerful tool that influences how much money flows around in the economy. They control not just individual borrowing, but also the overall health and growth of the entire economic ecosystem. Imagine you're running a lemonade stand on a busy street corner. Now, let's say the bank suddenly drops the interest rate, like when your parents decide to pay for something more generously. This is what happens in real life with businesses and lower interest rates. When interest rates are low, it's like getting an extra allowance. Businesses have easier access to loans from banks or other lenders, making it cheaper for them to borrow money. With this borrowed cash, they could do big things, like building a bigger stand, hiring more friends to help sell lemonade, or buying new equipment. All of these actions mean the business is expanding, growing its operations, and potentially taking on more customers. And here's the surprising part. When businesses expand in this way, it doesn't just benefit them. It affects everyone in the community. More people are hired, so those workers can spend their extra income at other local stores or services. New factories or stores mean more goods available for consumers, which can lead to even more demand and economic growth. Now, let's flip this around. Imagine instead that interest rates go up, like your parents decide they want you to pay with cash only unless absolutely necessary. This is what happens when interest rates are high. Businesses find it harder and riskier to borrow money, and as a result, their expansion plans become more cautious or even put on hold. Higher interest rates mean that every dollar spent on borrowing costs more. So instead of expanding, businesses might save up for bigger purchases, keep their current size, or cut back on expenses. This slower growth can spread out into the economy, reducing demand for goods and services, slowing down job creation, and potentially leading to less overall economic activity. In both cases, whether interest rates are low or high, the effect ripples through the entire economy. That's why central banks closely monitor these rates. They want to ensure steady economic growth that benefits everyone. So, we've talked about how interest rates affect business expansion through borrowing and investment. Now, let's dive into another crucial aspect of consumer spending. You might think that when interest rates go down, people just save more money in their bank accounts, but it's not quite that simple. Imagine you're at a grocery store, and you have two choices: a loaf of bread or a new set of kitchen knives. The price represents the cost to manufacture these items, the effort and resources needed to produce them. Now, when interest rates are low, it's like the manufacturer is offering you a better deal on that set of knives because they're borrowing money at cheaper rates. With lower interest rates, financing becomes more attractive for consumers. It's as if your credit card offers you a 0% introductory period. Buy now, pay later with no extra cost. This makes it easier and cheaper to take out loans or use credit cards. And when people can borrow more cheaply, they're more likely to splurge on big-ticket items like houses, cars, or even just everyday goods. Take buying a car, for example. If interest rates are high, the monthly payments could be quite steep. But with lower rates, those payments become more manageable. Suddenly, it's within reach for many people to buy that new car they've been eyeing. This increased spending trickles down and boosts demand in various industries. And here's the surprising part. As businesses see their sales rise due to higher consumer spending, they feel more confident about expanding their operations. They might hire more workers or invest in new equipment. This chain reaction is essential for economic growth because it creates a virtuous cycle where everyone benefits. Consumers get access to more goods and services, and businesses thrive. So we've talked about how interest rates affect consumer spending, savings, and credit availability. Now let's take a step back and look at the bigger picture, how central banks use these tools to balance economic growth with stability. Imagine you're steering a giant ship through stormy waters. The ship symbolizes the economy, and interest rates are like the rudder. If the economy is moving too fast and inflation starts to rise, making everything cost more than it should, the central bank can raise interest rates. This makes borrowing harder, so people spend less and save more. It's like slowing down the ship to keep everyone afloat during a storm. Conversely, if the economy is struggling and needs some juice, maybe there are too many layoffs or businesses closing up shop, the central bank might lower interest rates. Lower rates make loans cheaper, encouraging spending and investment. This helps the economy pick up speed again, like giving the ship an extra boost to navigate through calmer waters. The key here is finding that sweet spot where the economy grows steadily without overheating. It's a delicate dance, but it's essential for everyone's financial well-being. So, next time you hear about interest rates going up or down, remember, these aren't just numbers on a screen. They're part of a broader strategy to ensure the whole economy stays balanced and healthy.